Jeff, just start on politics plus economy. Jobless claims taking higher delinquencies for housing on the rise. That's Main Street. How do you pair that with what we might see in November?
Well, look, I think regardless of who's in the White House and how the Congress ends up, I think there's got to be more fiscal spending. There's got to, we do have what I would call the fiscal cliff here, which is, that so far the economy has been more resilient, I think, than people give it credit. People expected it to be because of the payments that have been made to individuals. It's sort of kept a buoyancy in consumer spending, even though, I mean, it's off significantly. It's not anywhere near as bad as maybe people thought it could be. And so when I look at what ends up happening in the fall, the policies are either one. Whoever ends up in the White House is going to be a massive fiscal policy that comes off the back of this, probably as a stimulus.
Jeff, with a potential Biden-Harris administration, you do see the potential for higher capital gains taxes, higher personal income taxes for the wealthy. How are wealthy investors likely to push back on some of that?
Look, it's we got to pay for this somehow, and I think the market has to factor that in. Nobody likes higher taxes, but at the end of the day, we got to figure out how we're going to get our way out of this challenge, both on a federal, state, and local level. And taxes is going to be part of our future, and I think the market has to factor that in. It probably already has. I mean, again, I think when you look at whoever's going to be in the White House, there's a few absolutes. One of them is there's going to be another fiscal stimulus that comes, and we got to figure out how to pay for it one way or another. So, yeah, I would say definitely increase taxes, and that's going to be something I think the market is already contending with.
Really, I'm just surprised because I feel like that would hit tech, but yet tech is still at record high. Like, where do you think it has been realistically discounted?
Well, so I think there's two things that are counterbalances to that. One is you have a massively accommodative Fed who's pushing everybody into risk assets. So if you think about the rally that's come off the bottom here, at the end of the day, it's hard to fight that, hard to fight the Fed. And so, that was higher taxes and more monetary stimulus. It's not something that any of us were thinking about in January or February. So you kind of have both those two countervailing forces working against one another, and so that's why I think right now the Fed seems to be winning, but it's hard to say that the market doesn't expect there to be some reckoning at some point around tax revenues. Otherwise, how are we going to pay for all this?
Well, when you look at that reckoning, Jeff, what is the downside risk here? Do you think that the S&P does end this year significantly lower if we see some of these economic statistics look as bad as they are coming out to be?
I mean, it certainly could. I mean, it's hard, even if you ran a Monte Carlo simulation on everything that's happened this year, if you had in your, random walk down Wall Street, some scenario that looked like the scenario of 2020, which I got to tell you, I'm not sure anybody would have ever had that. This is not the outcome that would have produced, right? And so we're living in a time where anybody who says they have some, crystal ball or some certainty around outcomes, given what's happened this year, just isn't being realistic. I think the key that we've been saying to investors and to our corporate clients, you got to be nimble. And one of the things that's happened this year that I think is really critical is a lot of companies have taken this opportunity to refinance themselves or to put more equity underneath them for whatever the uncertainty is going to be and whatever the outcome is, both politically and with the virus. And those are healthy things. If you look at the savings rates on consumers, that's a really healthy thing too. So even the consumer, consciously or subconsciously, is squirreling away money because of the uncertainty. That's actually a really positive thing, in my opinion, because at the end of the day, however this plays out and whatever it looks like on the back end, people want to have resiliency and the ability to continue to live their lives, both corporate organizations as well as individuals. And that's what we're seeing in the market, right? And that's what we're seeing in individual consumer behavior as well.
Or if you're Apple, you're like, hey, I'll just raise a bunch of cash because, why not? To hone a little bit more in on the Fed, I wonder what we learned yesterday from the Fed minutes and the market reaction. John Authers, who worked at the FT for decades and now is a columnist here at Bloomberg, said, look, if markets disliked those comments about yield curve control so much, it suggests that a lot of the money is now resting on the Fed coming through with another dose of financial repression and allowing inflation to rise. And that echoes what you're talking about in terms of raising a lot of debt. We've seen some money move out of high yield. Do we have an inherent bias now to the Fed, and does that create some sort of longer term risk?
Well, look, the market always likes to latch onto things where there's a degree of certainty. Fed actions are something that you can, they seem really binary, obvious, what relative to the uncertainty of how the virus is going to play out, or the uncertainty of the political climate, right? The Fed is a steadying hand. And so, you'll get comments like, people will read through them because everybody's focused on the Fed, and there'll be some noise and volatility around minutes when they come out. People try to read the tea leaves. At the end of the day, let's be really clear. Chairman Powell said he will be there with the fire hose to ensure that there's ample liquidity, and as continue to read the economic data that he gets more of it than anybody else in the world, and the Fed will react to those that data as it sees it to ensure that there's stability in the economy. That is a really powerful message, and I think many investors kind of miss that. Right? People get hung up in the tea leaves and the minute-to-minute moves in markets. And the reality is, you just take a longer-term view. Fed's going to be here with lower rates. It's got a lot of tools in its tool belt, even further out the curve. Right? We've seen it before. So now, I think people take a lot of comfort in that.
Jeff, do you think that there's going to be a great re-envisioning about the role of the Federal Reserve?
I think we had that last decade. I think, what Ben Bernanke and Janet Yellen did told us all we need to know about the fact that there's a lot of creative people there. And listen, the lesson from the global financial crisis is that the Fed was unwilling to take prophylactic steps in order to stave off the global financial crisis in 2008. There were a lot of things the Fed could have done that would have made the impact of the global financial crisis at the end of 2008 a lot less devastating. And so they learned from that. And so very quick to pull the trigger here to get the markets liquid in March. By the way, I think that was a great move. I know there's been a lot of criticism about the fact that it's bailed out the banks. The reality is, like them or don't like them, the banks are critical suppliers of liquidity to the market. And if the liquidity in the market freezes, then all bets are off. And that's what we learned in 2008. So I have to praise Chairman Powell and the Fed for doing the things they needed to do just to maintain some market functioning and stability while this thing plays out. And then it's really up to the fiscal policy to take it from there.
I do want to bring us back to the elections for a second here, because it is the biggest thing that people will be talking about once they come back from Labor Day. What is the biggest concern your clients have as we approach November?
Well, I think people are talking about it now. I mean, we've been encouraging all of our employees at Cowen to try to take a week off. It's really hard, because, everybody's engaged 24/7. So I actually think we're in the throes of it already. People are expecting to come back after Labor Day and everyone be focused on the election. How are you not focused on the election now? I think, listen, I tend to focus on places where there's actually remarkable consistency. Anti-China sentiment is embraced bipartisan, so I don't expect there to be a change in the tenor towards global trade. Job creation domestically, that's a Republican and a Democratic tenet. I think reshoring of jobs, building industries that will create American jobs. There may be some disagreement around that between Republicans and Democrats, but they both want to see jobs. Republicans tend to be focused a little bit more on the industrial sector. Honestly, Democrats tend to be more focused on sustainability and things where we can create new American jobs, high-paying American jobs that focus on climate change and other things like that. But at the end of the day, when you look at it, there is an intense focus on the part of both parties to do the things necessary to get Americans back to work, and that's a really positive element, I think, regardless of it. So people can focus on the differences. I think they're largely rhetorical and political. There's some very big social differences. But the markets themselves are looking at this and saying, it really doesn't matter who's in the office. This is such a huge problem that needs to be solved. There's going to be increased fiscal stimulus. It's just a matter of where it goes.
And to round it out here, Jeff, I'd love to get your perspective on how's business? What's your visibility in the back half of the year?
So business has been pretty good. And I think that's a function of the fact that a lot of our clients have chosen to finance, and we're very big and very active in the financing space. I would say, there's been some new businesses that have emerged. The SPAC business has actually emerged in a meaningful way as a viable way for a lot of private companies to access the public markets. I like to tell people it's an overnight sensation, 25 years in the making. SPACs have been around for a long time, but now they're the flavor of the month. There's been more SPAC and biotech IPOs in this year than maybe in any other year. Cowen's good at both of those. And we've chosen to focus on those. We were focused on them before the crisis, and it turns out those are really good businesses to be in this kind of an environment, as everybody's trying to figure out how to finance themselves and get access to capital. I don't see that changing anytime soon. Certainly don't see it changing, whether it's a Republican or Democrat in the White House. I think at the end of the day, companies need to make sure they have the resiliency and sustainability to execute for as long as this crisis goes on. And the best way to do that is to get access to capital.